Good morning. Last time we talked about what's GDP, and as we said, GDP is the market value of all final goods and services produced in a country during a specific period of time. As we said, this definition has four keywords. They are market value, final, in a country, and specific period. Then we talked about the circular flow model and the connection between the four sectors of the economy through the three markets. Then we talked about measuring GDP, and as we said, there are two different approaches for measuring GDP. Expenditure approach and income approach. Using expenditure approach, GDP is calculated as C plus I plus G plus X minus M, where C is consumption expenditure, I is investment, G stands for government expenditure, X stands for exports, and M stands for imports. X minus M is net export. What about income approach? As we said before, there are four main factors of production, which are land, labor, capital, and entrepreneurship. So land earns rent, just the same words or the same meaning, but using different words. So instead of rent, it's gonna be rental income. Labor earns wages. So instead of using the word wages, it's gonna be compensation of employees. Capital earns interest, so it is net interest. And finally, with respect to entrepreneurship, entrepreneurship earns profit. But here we have to differentiate between whether it is a corporate or sole proprietorship. So it will be corporate profits and proprietor's income. So these are return to factors of production. So if we are going to add all of them together, this is known as net domestic income at factor price. But we would like to convert it from factor price to market price, as by definition GDP is the market value, not the factor value. So we have to convert it using indirect tax and subsidies. So we have to add indirect taxes minus or less subsidies this will be net domestic income at market price. Now we would like to convert it from net to gross, as it is gross domestic product, not net domestic product. So we have to add depreciation this will be GDP using income approach. So we can conclude that if you would like to convert net item to gross item, you are going to add depreciation. So say for example, if you would like to calculate net investment, it can be calculated as gross investment minus depreciation. What's meant by depreciation? Depreciation means decrease in capital stock due to tear and wear, or in other words, resources are capital is depleted. Okay. Example. If you are given the following, Okay, given this information, calculate GDP using two different approaches, income approach and expenditure approach. Let's start with the expenditure approach. As we said, according to expenditure approach, GDP is calculated as C plus I plus G plus X minus M. Consumption is 1,000 plus I. This is net investment, but we would like to find gross investment. So we have to convert net investment to gross through adding depreciation. So gross investment is calculated as net investment plus depreciation. Net investment is 200 plus depreciation, which is 50, so it's 250. Plus government expenditure 700 plus X minus M, so it is net export negative 100 So if you are going to add 1000 plus 250 plus 700 minus 100, this will be GDP using expenditure approach. It will be 1850. Now GDP using income approach. As we said, it's the summation of rental income, corporate profits, proprietors income, net interest, and employees compensation. Employees compensation 1500, corporate profit 200, proprietors income 100. 1500, corporate profit 100, proprietors income 200. Rental payment 50, net interest 20. 50 and 20. We have to add the 5 items together in order to get net domestic income at factor price. $1,870. If you would like to convert it from at factor to at market, then we are going to add subsidies minus taxes. Subsidies is 150 and taxes 100. So the difference between subsidies and taxes is 50. So this will be net domestic income at market price. It will be 1,920. And finally, we would like to convert it from net to gross. So we are going to add depreciation. Depreciation is 50. So it's 1,970. This is GDP using income approach. Now we have to differentiate between something known as nominal GDP and real GDP. What's the difference between nominal and real GDP? Nominal GDP is the market value of all final goods and services when valued at current market prices. So it's calculated using current prices. So it's gonna be calculated as summation quantity current multiplied by price current. This is nominal GDP. So say for example you would like to calculate nominal GDP if you are given the following. This is the quantity and the price for year 2019 and quantity and the price for year 2020. Okay, let's assume that the country is going to produce just two commodities, Pepsi and the chocolate. If the number of units produced of Pepsi in year 2019 is 100, the price per unit is $1. And with respect to chocolate, it's 20 units. The price per unit is $5. And the same for year 2020, it will be 160 units or cans of Pepsi. Price of each is $0.5. And with respect to chocolate, it's gonna be 22 units. The price of each is $22.5. Now we would like to calculate nominal GDP for 2019 and nominal GDP for 2020. It's gonna be calculated as quantity current multiplied by the price plus for the other commodity is gonna be quantity current multiplied by the price. So it will be 200. The same with respect to year 2020. It's quantity multiplied by the price plus quantity multiplied by the price. So nominal GDP for 2020 it will be 575. Okay, what about real GDP? Real GDP is calculated as market value of all final goods and services valued at base year price or constant prices so real GDP will be calculated as quantity current multiplied by B base. So we are going to keep the prices constant, prices of the base or the reference year. we are going to use the same example, this is quantity and the prices for year 2019, 101, 20 and 5, and this is for year 2020. And we would like to calculate real GDP for year 2019 and year 2020, given that year 2019 is the base year. So real GDP for year 2019, it will be 100 multiplied by 1 plus 20 multiplied by 5, which is 200. Real GDP for year 2020, it will be, we are going to keep prices constant, prices of the base year constant. So we are going to use these prices and these quantities. So it's 160 multiplied by 100 plus 22 multiplied by 5. So it will be 270. So we can conclude that real GDP equals nominal GDP for the base year. With respect to base year, real GDP is 200 and nominal GDP is 200. So nominal and real GDP for the base year are the same. Now we would like to calculate two additional indexes. They are GDP growth rate. As we said before, that one of the main objectives of any country is to increase the economic growth rate. So now we would like to calculate the growth rate. And index number 2 is related to prices, which is an indicator of the general price level. It's known as GDP deflator. So we are going to use nominal and real GDP in order to calculate these two indexes. Number 1, GDP growth rate. GDP growth rate is calculated as real GDP at time t minus real GDP at time t minus 1 divided by real GDP at time t minus 1 multiplied by 100. Returning back to our example, if you would like to calculate GDP growth rates for year 2020, so it will be real GDP at time t, which is year 2020, 270, minus real GDP at time t minus 1, which is 2019, which is 200, divided by 200 multiplied by 100. So it's about 35%. This means that about the country's production is going to increase in year 2020 with respect to 2019 by 35%. There's an additional production of 35%. Okay, what about GDP deflator? Later on we are going to explain more about GDP deflator when we are going to talk about inflation. But for now, GDP deflator is an indicator of the general price level. GDP deflator is calculated as nominal GDP divided by real GDP multiplied by 100. So, returning back to our example, GDP deflator for 2019, it will be 200 divided by 200 multiplied by 100, so it's 100. And with respect to year 2020, it will be 575 divided by 270 multiplied by 100, $230. So this is GDP deflator for year 2020 and 2019. From this we can conclude that GDP deflator for the base year will be 100 without any calculations. We can note that GDP deflator for the base year is 100. This is the end of our lecture today. Thank you.